Hi and welcome to this other Q&A in school. And right now we only have actually a note-taker attendee, but I have received a couple of questions that I will go through pretty quickly, and we'll see if somebody else is joining today. Otherwise might have to think about this format, because if Q&As is not in demand, then we will do something else for the community in terms of getting all the lessons and lessons across. So the first question here is, you mentioned that PEG is a fickle friend. In what scenarios have you found PEG most misleading, and how do you avoid being fooled by it in real world investing? So PEG, it's the price earnings ratio to growth. So for example, if the price earnings ratio is 25 and the growth rate is 25% per year, then the PEG ratio is 25 over 25 equals to 1. When I started out investing over 30 years ago, a typical PEG ratio as a benchmark used to be about 1.0, but actually a number closer to 2 is more logical. For example, if the growth rate is about 15% per year and your PE ratio is 30, then you would have a 30 over 15 equals 2. And actually, if your company, if the earnings per share is growing by about 15% per year, then probably a price earnings ratio of about 30 is more or less warranted. Depends, of course, on for how long you expect that growth rate. But if the growth rate is for 10 years or more, then something like that might be warranted. And then the higher the growth rate, the higher the PEG ratio, the warranted PEG ratio as well. So for example, if the growth rate is 100% per year, if the PE ratio is, let's say, 100, or let's say it's 200 actually. If the PE is 200, then after 1 year it falls to 100. After 2 years it falls to 50. After 3 years it falls to 25, and after 4 years it falls to 12.5. So if the earnings is actually growing by 100% per year for 4 years, then after just 4 years, 200 will have fallen to 100, 50, 25, 12.5. So after 4 years, let's say the growth rate is still at least as high as for the average company on the market, and then the company would have become cheap in just 4 years' time, growing at 100% per year. Now that would be a very unusual situation and very difficult to predict with any certainty, but at least it shows you that given that you have an idea of the growth rate and that idea is 100% per year, then the PEG ratio of 2 would actually be very cheap, even if the price earnings ratio was 200 and the growth rate was 100. The problem with PEG ratios is that it's only really relevant in kind of a mid-figure scenario. Going, for example, at the extreme in the other end, let's say something grows by just 1% per year and the price earnings ratio is 14. So let's say 10, just to make it even more relevant. A company that is has more or less flatlined. It's not growing, it's not shrinking, it just sits there producing the same profit or same earnings per share every year. But let's say it's growing just slightly to avoid division by 0. So let's say it's growing by 1% per year and the price earnings ratio, the PE ratio, is 10. Then you would have a PEG of 10. That would sound extremely expensive, but actually a company that is producing reliably the same profit every year, growing by just 1% per year in this case, that would be cheap, or at least fairly valued at a PE of 10. So in that case, a PEG of 10 is cheap to fairly valued, but somewhere in the middle, let's say a company is growing by 20% per year, and they would not warrant a 200 price-earnings ratio. So they would definitely not warrant a PEG of 10. Maybe they would warrant a PEG of 4, perhaps. Let's check with back of the envelope mathematics. So let's say they had a price-earnings ratio of 80 and a growth rate of 20. So that would be a PEG of 4. Growing by 20% per year, that is about a 10% per year faster growth than the average company. That would mean that in 7 years' time, using the rule of 70, in about 7 years' time, that company would have grown relatively to twice the size of the average company, and that means that the price-earnings ratio, you could say, it falls from 80 to 40 in relative terms, and that would actually still be quite a highly valued company. It would take another doubling to get down to 20 times earnings, whereas the market is still flat at around 15 times. So at that level, you would definitely say that a PEG of 4 is expensive, but probably a PEG of 2 is more or less warranted. So at a 20% growth rate, you could say that a PE of 40, if at least the growth rate is pretty sustainable for 5 to 10 years, then it's probably warranted. So in the end, you typically end up with in the mid-range, let's say growth rates between 15 and 50%, more or less. At around there somewhere, a PEG ratio of 2 is more or less fairly valued. So the question then continues. Well, in what scenarios have you found PEG to be most misleading? Well, I've never really used PEG for anything else than the absolute first coarse-grained screener. You might want to screen out anything with very high PEG ratios if you look at software companies, and you're not really interested in super low PEG ratios, because what you find there is probably value traps anyway. So when you're looking at successful mid to large software companies, then what I typically have done is screen for companies with between let's say 2 and 6 in PEG, and whatever I find there I do some more nuanced research and calculations on. So there really isn't any room for making stupid errors, because nobody in their right mind would just use the PEG ratio for investing. It's used for screening and then doing more research on. So the easy way to avoid being fooled is simply don't use it, which I don't either. But at the same time, it can be just one of 10 data points in a triangulation, just to make sure it doesn't stand out in any weird way. So, given Microsoft's current PEG of 2.35, what specific risks or assumptions would make you hesitant to invest, and what would you need to change for it to become a clear buy? Well, to start with, the PEG ratio doesn't really come into it doesn't really affect my willingness or not to invest in Microsoft. What it does tell me is that Microsoft is somewhere in the middle, in the mid-range, growing having a PE ratio of around 30 and growing by 12% or so per year, it's more or less a reasonable range. So what then becomes interesting and what you need in order to avoid investing or to actually become eager to invest in Microsoft is to look at the details of its coming the growth rate for its various products and regions, I would say, and also in terms of what margins one could expect for the various products and services. What I really would like to see for Microsoft to be attractive at the current PEG ratio, or even actually more important, at the current price earnings ratio of more than 30, what I would like to see is some credible information pointing toward an acceleration of growth, because at just about, let's say, 12% EPS growth rate, it's actually not that high, that much higher than the market average for it to be to warrant a 2x multiple of the market. So I would need to see some traction for perhaps in Gen AI, seeing that OpenAI is gaining lead in one or two important areas, where I would like to see some perhaps new ventures for Microsoft, which are really taking off in terms of growth. But in general, I don't really see this happening. Microsoft is a very good company. It has a strong position in many areas, but I can't really see Microsoft suddenly accelerating or exploding upward in any of its areas. Rather, it's a kind of an old behemoth, an old large company that are more reactive than proactive in their various business areas. And so I don't expect to be surprised when it comes to Microsoft, and rather I would expect it to slowly be derating in terms of its price earnings ratio. And I also, in a way, expect its growth rate to also be slowly falling toward maybe a level just slightly above the average for the stock market. So if you ask me, in 4 years' time, I would expect the price earnings ratio to fall from maybe the current 30 plus down to about 25. That would still be pretty high, but it's this is Microsoft, and it's one of the top 10 companies in the world. It will always attract index money, and at 25 times price earnings ratio, that is probably more or less warranted if they have a high cash flow conversion, which they do with their software-oriented businesses, and at let's say they are growing at a 10 to 12% clip in terms of earnings per share. So I would expect them in 4 years' time to have fallen from 30-31 price earnings to maybe 25, and the growth rate to have fallen from maybe 12% to closer to 10%. So in order for this to become a clear buy, I would want to see the share price quickly fall by 30, 40 or 50% in a kind of a panic, something where index funds are forced sellers, some kind of a panic where the huge asset managers are realigning, reweighting their portfolios from stocks to bonds or alternative assets. But this is wishful thinking. I don't think anybody could invest in this kind of just hoping for Microsoft to become cheap. But right now it's kind of fairly to slightly expensively valued, and the PEG ratio really doesn't come into that doesn't really come into becoming any important factor here. Let's see, what else have we here? You define risk as the likelihood that your forecast misses on the downside. How do you personally model or prepare for those miss scenarios when evaluating a stock like Microsoft? Well, what I do is I try to make the best forecast possible, of course, using everything I know about past performance. I mean, how quickly has Microsoft been growing? In what type of cycles? How important have their new product launches been for the short-term and long-term growth rates for Microsoft's earnings per share, which I think is probably the most relevant measure actually for Microsoft. Most intuitive and easy to model for most people. So I make the best forecast I can, and then how can I ever estimate my uncertainty and the risk that my forecast will be missed? Well, again, I look toward the history and I see what type of variability has Microsoft exhibited in its earnings per share growth rate. And that is probably pretty indicative of the future volatility. And had I been standing 20 years into the past and looking forward to the coming 20 years for Microsoft's earning per share growth rate, then I would probably have made, again, just a kind of a point estimate of, let's say, believing Microsoft would grow by 15% per year in earnings per share, but the actual outcome would probably have been a pretty higher difference. Let's see here. Let's go through snapshots. Let's look at financial analysis, highlights, and let's just see what Microsoft's earnings per share growth rate has been over the last 10 years. And here it is pretty soon. Let's see if I have shared this one. I haven't yet. I'm going to share this one. There we go. So here we have the diluted earnings per share year-on-year growth rate. As you can tell, it's been at its worst -10% and at its best +50%, and with an average of maybe around 20% for this 10-year period, something like that. So let's say I made a correct guess of 20% per year, and apparently some years I missed that by a lot, with falling by 10%, but only on a quarterly basis. Let's actually check the annual numbers, because that might give us a more clear picture. This is what, so we were looking forward toward maybe a 15 to 20% per year, and sometimes we got -30% and sometimes +130%. That tells us something about the single year uncertainty. However, these in retrospect didn't really matter, because the average was still like a high double-digit positive number. So coming back to the actual question here, how do you personally model or prepare for those missed scenarios? Well, the most important answer to that is just keep a margin of safety. I mean, you should not invest in a company like Microsoft if you only expect like a 15% annualized return going forward, especially not if it's a highly innovative technology company that is facing competition from like the 10 to 20 most innovative companies in the world. If you have already seen that it sometimes it crushes estimates and sometimes disappoints heavily, then there is absolutely no reason to invest if you only see like a 15% annual potential return. Rather, you shouldn't invest in Microsoft unless you perhaps see the potential for 25% per year for 3 to 6 years. That means that it could double or quadruple in 3 to 6 years. If you have that kind of an outlook on the company, then it's worth taking the bet that your forecasts will miss. So the only real answer here is keep a high margin of safety, because there is no way that I, as a private individual, can make better forecasts and pinpointing whatever Microsoft will do, if, as we can tell from history, that the growth rate varies widely for a company, even a big company, a super well researched and well established company like Microsoft. And the EPS growth rate still varies hugely, and there's no way that I or anybody else can forecast that with any precision. And that's why we need to keep a higher margin of safety than usual, making sure that on average we will get a really good payment or reward for taking on that risk. Okay, let's see here. We have an AI assistant helping Steve Way take notes. All right, okay, that's not for us. Yeah, actually, that was the questions for today. I mean, just to summarize, I think the PEG ratio is useful in as much as it's one of maybe 10 factors to take into consideration. But there are many more. But the really important thing to think about when you're trying to estimate the value of a company is, one, how did the company end up here where it is right now? I mean, wait, what's this? Oh yeah. How did the company end up where it is today? What type of fundamental growth rates did we see historically? Maybe I was looking at the wrong numbers before, because this looks much more reasonable than the weird numbers we were looking at before. So this actually looks much more like the Microsoft I remember, that they have a pretty stable annual growth rate, and with some variations. Actually, looking at the picture like this, Microsoft seems enormously stable in its growth rate. Like, this looks really reliable, and an annual growth rate of, I mean, I must have been Koifin must have been feeding me the wrong numbers before, because this is the way it should look. This is a company exhibiting less risk than the market, and just seeing the revenue growth rate of very stable 15% per year, and with a few slight exceptions. This shows you that, of course, again, you should have a margin of safety, but with this reliability in terms of growth rates and let's check EBITDA margin, this type of reliability in terms of increasing and high and stable margins, that also looks much better. And in terms of diluted earnings per share, the total trajectory here looks very reliable, even if the annual growth rate varies quite a lot. The important thing here is that the overall trend for the actual level of earnings per share is pretty stable. So coming back to the question again, about how to avoid or make room for the risk the risk of permanently lower profits potential. You should always combine all of these various aspects of the company's growth in fundamentals. So, for example, here we see the end result, the earnings per share. This is what ultimately is what we value for the company. So we are currently at 11.80 in the annual level of earnings per share, even if the growth rate is of course important, the single years are not that important. But what we want to do is combine this picture and our likely extrapolation into the future. We want to combine that with this kind of risk that we see here in terms of year-on-year growth rates. But as you can see, if you toggle between these two pictures of actual earnings per share level and the growth rate, you can see that we get a year here with minus 35% and then a year with plus 150%. This looks really dramatic on the growth rate picture. But if we look at the actual earnings per share, what we see is that it was just a single year with kind of a one-off effect, and then we got just right back on track here. And we could probably have foreseen that if we were looking at just the growth rates of the top level sales, which had one pretty weak year but still growing. The problem is that margins and maybe one-off costs were high here, as the company was itself expecting maybe 15% per year. And going even more top down, just looking at the nominal sales level rather than growth rates, what we can see here is that that downturn that created a huge fall in EPS and then a 150% explosion in EPS, it doesn't even register on the revenue chart. So the revenue chart here is what tells us something about the stability of Microsoft's position and growth rate. And the gross profit margin, it's also very important in terms of telling us something about how successful Microsoft is at managing their business, their clients, their costs, their margins overall, even if there are variations. Like here, for example, a pretty surprising, suddenly a slight decline in the gross profit margin. This probably surprised the market and the company itself and so on. But just after 1 year and the year after that, they are back at record high margins, and this is likely to continue, just as this progression for total revenues is likely to continue. So what we do here is we establish more of an overall total growth rate as they work on their current and prospective clients and just keep churning out better and better products. So the way to minimize forecasting errors is to, of course, combine as many of these fundamental drivers as possible, as well as cross-checking with other similar companies and see what are they saying in terms of their guidance. So you can what you should do then is check the actual earnings reports, both from Microsoft. You check their investor relations homepage, both for Microsoft and Microsoft's competitors. So typically just Google Microsoft IR, you get right into the investor relations. You have earnings and financials, earnings releases. Let's see if we latest earnings release. let's see where we have it here, and what you always get is a business outlook. Unfortunately, we didn't get it right here, and what we need to do is look at the presentation. Anyway, Microsoft will, in its earnings releases, it will detail what they are seeing currently and what they are guiding toward, and that creates even more nuance and less risk of negative surprises. And you can also use the earnings releases from other similar software companies to see if they are saying something different, and that could also reduce your forecasting error, but usually only for the closest year or so. When it comes to the long-term trends, I still think that the best thing you can do is just see how have they been performing up until now, and is there anything obvious that has changed, and unless there isn't, then I would assume that the status quo prevails and that they will keep growing more or less as they have done up until now. So that about that, but again, as you can tell, it's it apparently is very difficult to make these kinds of forecasts because people get it wrong all the time. But it's also interesting to see that typically what the market gets wrong is that it gets too optimistic and too pessimistic based on just a single quarter or a single year that is disappointing or outperforms just a little, and often actually for pretty obvious reasons, where you can see that it had a bad year because of the inflation in 2022 or due to some other factors, and then it had a good year because it just made a comeback, and there's no reason to change the valuation multiple for normalized earnings or sales just based on a single year. But the market does that again and again, and that is what's creating the potential. I mean, just take a look at Microsoft's 10-year chart here. Why did the price fall from 350 to 200? Was there anything in their numbers here in 2022 that was actually warranted that type of a D-rating? Well, maybe the market was right here, so now it only got back to where it was right. But in any case, it couldn't have been both right here and right at this point. There's something wrong with the market when it's trying to estimate the value of a company like Microsoft, when it can change this much in just 1 year. Because the total outlook for Microsoft, it's determined in a completely different way, and in a way that I think is apparent or clear from watching and analyzing 10 or 20-year trends of actual sales and margins. And right now, I think the market is probably too optimistic in its view of Microsoft. Well, we can actually let's see. Let's just take a look at analyst estimates overview. So what we can see here is that earnings per share is expected to grow by 13%, and then actually accelerate to 17%. That is probably something that one should be suspicious about, because nobody really knows what's happening out here. And usually a sudden acceleration like this at the outer year is due to there being fewer analysts distributing their forecasts for these out years, and so it's this is just an effect of being too few analysts. But it could also actually reflect hopes for some kind of an AI acceleration. But these numbers in terms of earnings per share growth, they are not that impressive. And then just looking at their, let's see, the valuation multiples. Let's check price earnings last 12 months. We are at 35.6. It's almost as high as they have been for Microsoft. And that is, I would say, overly optimistic, considering that they are now growing more slowly than they have typically done before. And at 36 times last 12 months earnings, and growing at only about 12% or so per year. This looks more like an index disease type of effect, that money going into the market has to go into the largest companies, and that makes them constantly overvalued. However, that process will probably continue for as long as the market is going up. It's a self-fulfilling effect. But that does not change the fact that this is probably simply too expensive. It's hard to warrant this type of valuation. And once the share price and the market goes down because of forced selling or realignment of the large asset managers' portfolios, then we have nothing stopping it from falling, because it simply is too expensive. However, again, this is not an actual recommendation to buy or sell Microsoft shares. This is not an actual analysis of the company. For that, you need to put in more time, more effort, going more into detail. But what I can say is that from this top-down perspective of previous growth rates and a likely continuation into the future, previous valuation multiples, just remember that they typically have been lower than currently, and they are likely to be they're more likely than not to be to be more closer to their own average in the future than at an extreme, just simply from statistical reasons. So unless they accelerate their growth, or cash conversion, or in any other way is perceived as less risky, then the valuation multiples are likely to come down a bit. And I also think that the forecasts of 17% growth for EPS in 2027 is probably a little bit too high. All this said, there is always a potential for surprises, both positive and negative. And Microsoft has surprised in its history again and again, and coming back with a really strong both growth rate and profitability and new product. And they might very well do that again, but we don't know that. It doesn't really give us any margin of safety if we assume that they will. It could still, of course, in retrospect, turn out to be a good bet, and it has been a good bet to stick with Microsoft. But the price for the return we have gotten from Microsoft is that it is currently very highly valued. So that is something that is very difficult to see happening again. I mean, we have a re-rating here for over the 10 years from 18 times earnings at the low point here to today's twice as high valuation as at 36 times earnings. This will not happen again. I mean, even at with the most optimistic scenario, we could perhaps hope for 36 times earnings for Microsoft to stick around at this level. And that means that the only returns we will get as investors is the underlying fundamental growth. So if EPS or sales grow by about 15% per year and the valuation multiple stays put exactly where it is at a pretty high level, then we will get as total return, we will get the underlying fundamental growth, let's say 15% per year, if we are a bit optimistic. And it's more reasonable, not necessarily correct, but it's more reasonable to assume we will get slightly lower growth than 15%, and we will also, especially if growth slows, we will also get lower valuation multiples, at least as an average. And that means that we're more likely than not to get maybe a 10% CAGR the coming 5 years than any number higher than that. And that would be a pretty poor investment prospect, and there are probably much better alternatives out there. So a long-winded answer to these questions about PEG ratios and Microsoft. But with that, I think we are done for today. And as a concluding remark, I think it's also, even if these are early days, I think it's safe to say that the Q&A format is not really in demand here in the school community. So we will look into that and see what else we can do in order to provide you, the members, with the absolute best way of using me and using the community for better understanding, better investments, and as I always say, the goal of all investments is to make for as meaningful and sustainable a life as possible. And right now, these Q&A sessions do not really seem to be the path there. So thank you for today, and see you next time.